The SPY is down almost 2.15% in a single day. It's actually been a while since the SPY has been going down that much, and I thought it was interesting to make a video to see how you can actually yourself take advantage of such a big down move when we look at how the implied volatility is right now in the markets. Because even though if the market is going down and it can seem quite a bit scary at first, it's actually giving you a lot of opportunities. And in this video, I'm going to share what is my thought process when the market is going down like this, what are my positions doing. I'm going to show you my P&L so you can really see how my portfolio is doing during this down move and what I'm planning on doing, so hopefully it's useful for you if you're willing to do the same. If we just look right now at the SPY, which is basically the S&P 500 ETF, what we can see is that the SPY is down 9 points. And to give you a bit of context, the SPY being down like 9 points actually represents a loss of more than 2% on the day. And it's not every day that we have like a down move of 2% on the SPY. And as you can see on the chart right now that I have, we can see that actually the SPY gapped down, meaning that at opening, the last close was at 440 and it opened at 434, as you can see at this level. So the first thought that you probably have, and personally I always have that, when I see in the futures that is going to be a big down move, like the first thing that you're thinking is that, oh my god, it's terrible, it's the worst thing that can happen. Is a crash going to follow? Is there going to be an even bigger down move just right after that? And as much as it's completely fair to think this, we need to understand that this is actually what you need to wait for when you're, for example, selling options, because a down move is bringing you a ton of opportunities. Let's look at my portfolio so I can show you what I mean. So if we look at my portfolio, so as you can see right now, I have a couple of positions on, and as you can see, most of them are actually long. And the reason why they're actually long delta is because all of my short delta positions, I just closed them before. If we go into my activity type, I can see that I have been closing some trades today. I have closed a call credit spread on Bank of America, and I have closed a call credit spread on CLF. That's the benefit of trading both sides. When you have like a big up day or a big down day, well, one side of your portfolio is going to benefit when the other one is going to lose, and that's completely logic. I mean, that's completely normal. There's nothing crazy about this. But the good thing is, when you have a down day like this, your short positions are going to go instantly in profit. I mean, you should have seen at the opening, literally I was at like 80% profit on both positions almost, and I just took them off, and that was a really easy trade. But obviously the question that everyone is thinking is like, what is going on with my long positions? What should I do? What are the things, what are the necessary steps as to try to repair those trades? Well, when you need to understand is that that's also one reason why you always want to trade small when you're trading options, is because you never know what can happen. And actually, you know, when you see, for example, that most of my positions right now are in a loss, that's actually quite a good reminder of why you need to trade small. And when you trade small, you're basically going to put yourself in a position where it doesn't really matter if the trade is going against you, because when you're selling options, if you decide to roll your option, or if you decide to roll your trade in general to the next expiration, you can easily do this because you have a ton of margin available and you always forecast this type of outcomes. And of course, right now, this is not, you know, the worst crash that we've ever had. I mean, just look at March 2020 to see how bad of a move it was. But, you know, this type of down moves just remind us of actually what can happen. And if we look at, for example, my buying power usage at the top, you can see that it's at 14.6%, meaning that out of my total net liquidity, I'm only using 14.6% of that capital, meaning that I have around like 86% of my net liquidity that is still available. So if your positions are in a loss and you have to roll your trades, well, because you actually leave a lot of buying power available for this type of things to happen, well, it's not a problem to roll your trades. And that's personally always what I'm doing. So for example, what I'm probably going to do at the end of the week, I'm probably going to have to roll a couple of trades. And if we look at, for example, let's say my trade on Foot Locker. So as we can see, I have sold a put on Foot Locker. And if we look at, for example, the strike, well, the strike is 47.5, meaning that if Foot Locker stays above my strike before expiration, then my option is going to expire worthless. And if it goes under, then I'm going to be assigned if it expires in the money. But the thing is, just having Foot Locker going toward my strike price is putting me in a loss. As you can see, I'm in a loss of almost $90, actually $90 on that trade. And if I, for example, decide to roll my trade, so rolling my trade means that I'm going to close my current trade, I'm going to take my loss of $90 and I'm going to sell another option in a later expiration. What we can see is that I would roll it for $1.50 of credit. And what that does is that that when you roll a trade, and especially for credit, you're widening your break-even zone. Your break-even zone, if we look at it right now, it's around 45.38, meaning that if the stock, when I will have rolled my trade, goes above that level at expiration, then I will be in a profit. Compared to now, if I delete the new roll trade that I want to place, if we look at it, my actually break-even is at 46.82 compared to before, where it was at 45.22 or something. So that's the benefit of not only trading small, but also selling options, and the fact of rolling for credit, is that when this type of down moves happen, well, it's actually a good thing in a way because it's bringing back more volatility. And if you have been trading small before, it's not really a problem to just put again a new trade with a better, let's say, probability of profit in a later expiration. That's why you're trading small, and that's why I keep most of my buying power available in case of a down move, so I can roll my trade quite easily. So that was to give you a bit of a portfolio update on how is my portfolio doing during this type of down moves. And of course, you know, as I'm long delta, I'm long delta, meaning that I bet that overall the stock market is going to go up. Of course, when there's a down move, I'm going to lose money. That's obviously part of the game. You have to lose somewhere. If you're short delta, meaning you think that overall the stock market is going to go down, then you'll be hurt when it goes up, and vice versa. Right now, I think that it's going to go up overall, so I'm being hurt when it goes down. So that was for my portfolio update. I wanted to do a bit of an update so as to show that, you know, of course I have losing trades. I mean, like everyone, and in down moves like this, you can see that today I lost $322. So obviously, you know, I'm being hurt when there is a down move. But the main subject of this video, and that's, you know, a very interesting concept to understand, especially when you're selling options, is that when you have a down move like this, it's actually going to bring a lot of implied volatility in the options. So what does that mean? If we take back our example of Foot Locker, so I can show you what actually does that mean in real life, the implied volatility. If you look at here, we can see that Foot Locker has an implied volatility of 43%. So what does that number mean? Well, it means that we expect a move of 43% either up or down. So if we look at, for example, what is the price of Foot Locker, it's around $48, or let's say it's $50 just to make it simple. So having an implied volatility of 43% when you have a stock of $50, it means that we basically expect a movement of 43% times 50, the stock price. It means that we expect a movement of around $21, either up or down. That's what we expect of the stock Foot Locker. So it means that we basically expect a move between $71 per share and basically around $27 per share. So that's basically what you expect with the current implied volatility. So the implied volatility is the expected move. That's what we expect of the stock, how it's going to behave over the next year. And that's a movement that could be either up or down, because obviously the stock could move either up or down. But when you have a down move like this overall on the stock market, when you see that the stock market is going down, there's an interesting phenomenon that is happening. The implied volatility tends to go up when the overall market tends to go down. And on the opposite, when the stock market goes up, the implied volatility tends to go down. And it's going to make sense in a minute. Let me explain you. When everything is going fine, the stock market is going up, and you know, no one is worried, everyone is becoming complacent in terms of stock market, and it's actually quite easy. So we expect less and less. We don't really think of a crash. But things get interesting when the stock market is going down. We always hear about those panic selling moments where everyone is just freaking out, selling everything. I mean, that's how a crash works. Usually the stock market tends to go down a lot quicker than what it goes up. I mean, we've seen that over and over. Either it's the crash of 29, 87, like the dot-com crash, 2008 or 2020. I mean, it's always the same thing. The stock market tends to grind up and it tends to go down a lot quicker. And when the stock market crashes, when the overall market crashes, what we see is that the implied volatility is rising. And in a way, it makes sense. When there is a big panic in the market, we expect like almost the world to, crumble. Like we expect everything to break. And for example, in 87, a lot of people thought that the entire financial system was going to collapse, when actually it didn't. And when we see where we are now, it absolutely did not end. And when we are in moments of like very big panic selling, that's where we expect like the worst to happen. It's the fear brings more fear, which brings more fear, etc., etc. So it makes sense that when the stock is going down, especially quickly, we expect the stock to go down to zero almost, like we think it's the end of the world. But you would probably tell me, okay, Cole, I get why you're saying this. I get that the implied volatility is rising when the stock market is going down and vice versa, but why does it matter? Well, it matters because the implied volatility, what we expect of a stock or what we expect of stocks in general, is going to impact the option prices. The higher the implied volatility, the more expensive the option price is. And the lower the implied volatility, the cheaper the option price is. And it makes sense. Let's take a very quick example, like just to really visualize it. You're going to see that it's so simple to understand. If, for example, let's say that you have a long stock portfolio, let's say you have put everything into a long stock portfolio, you have shares, you earn dividends, but you hear that there is a crash incoming, like everyone is going to sell their stocks, what are you going to think? Well, you want to protect yourself. So what you're going to do is that you're probably going to go buy puts so as to protect yourself against the crash. So if the market is going down, you're not going to lose that much money compared to if you hadn't bought a put. But what's happening to put prices when everyone is willing to buy them? Well, they actually increase in price. And the fact that everyone is rushing so as to buy puts, so as to hedge themselves against, like, for example, a long stock portfolio is going to make put prices go higher. And the implied volatility is a reflection of option prices. Like, the higher the option prices, the more expensive they get, the higher the implied volatility, and vice versa. So it makes total sense that when there is a crash, everyone is buying puts and you have the implied volatility rising because everyone is in a panic selling mode and everyone thinks the stock market is going to crash, so put prices are going higher and overall the option prices are getting more expensive. So now that I've explained that boring long concept, like, now we can get back to the fun stuff. When you have a down move like this, like the SPY losing 2% in a day, I can tell you, you always see the same thing. You always see the implied volatility rising when the overall market is going down, and you can always see the implied volatility going down when the overall market is going up. So if we look at the SPY right now, so this is the chart of the SPY, as you can see. So yes, the stock market is going down overall. That's absolutely a fact. What you have below the chart is the IV rank. So the IV rank is literally what it says. It's ranking the implied volatility, meaning the higher the implied volatility right now, the higher the IV rank, because the IV rank is measuring what happened over the past year, and it's ranking the IV so as to let you know, is the IV high or is the IV low? And that helps you know, knowing that if the IV is high, option prices are expensive, and the IV is low, then option prices are cheap. And what you can see is that you have the IV rank just below the chart, and you have the red line for the high, and you have the green line for the low for the IV rank. What we can see today is that the IV rank literally skyrocketed today. You can see that right now, if we look at the top, the IV rank is of 48.3, which is literally the highest, like, as you can see, would be right there. So when you have the IV going up like this, when you have the implied volatility rising, which means that option prices are getting more expensive, it's actually an opportunity for you as an option seller to sell more expensive options and make more money. Because when you're selling options, you obviously want to sell ideally more expensive options, because what you're receiving as a credit as an option seller is your profit. So if you can sell more expensive options, then good for you. You're going to make more money. Right now, you have in front of you the VIX, which is the implied volatility for the S&P 500. So compared to other stocks where we're just going to look at, for example, the IV rank or the implied volatility just on a chart, the S&P 500, the index itself, has basically a product that is its implied volatility. So the VIX is the implied volatility for the S&P 500. And it's often called the fear index because of reasons that are quite obvious. I mean, when it crashes, the VIX rises like super quickly because people are freaking out. That's why it's called the fear index. When the stock market crashes, it tends to go up. And if we look at, for example, back in March 2020, you can see that the VIX went from basically 14 to almost 84, 85. And that basically means that at some point on March 18, we were expecting a move of almost 85% on the SPYs. And that's always the same thing. Like, the VIX tends to go up very quickly and it tends to grind down, as opposed to the SPY crashing down very quickly and then grinding up. That's logic. And a very good measure of where is the market right now in terms of fear, well, you just have to look at the VIX. And what you can see, for example, today is that the VIX is stopping like 27, 28, and it literally closed at 21 on Friday last week, and now it opened at 24. Now it's at 27, almost 28. And you can see that last time where the VIX was that high, it was actually in May. And personally, I like to follow this rule. When the VIX is low, meaning that the stock market is continuously grinding up, I tend to sell credit spreads, meaning that I'm protecting myself in case if the stock market suddenly gets down. And during periods of high volatility, I'm going to sell more naked options because that allows me to take advantage of bigger premiums. Because as I just explained before, the implied volatility tends to rise when the stock market is going down. So not only because you are not selling credit spreads but naked options, you're making more money, but you're also making more money because the options are overall more expensive. So it's a double, they get even more expensive and you make even more money. And that's a bit the counterintuitive thing when you're selling options. And of course, you don't have to do this if you don't want to, but that's a nice opportunity when you sell options because you deploy capital into volatility. When there is more volatility into the markets, that's where, as an option seller, you have more opportunities to make money. And I know that sounds counterintuitive because you're basically selling more options when there is actually more risk, or what it seems risk, but it's actually probably the only moment where, as an option seller, you probably should sell more options. But of course, when we look, let's say, at the SPY and we see the SPY going down like this, the big question is, should you sell, for example, naked puts right now? Are you going to catch a falling knife? That's obviously always the question that all option sellers are faced. And of course, there is no one that could actually trade better than yourself. You know what to make with your money. You know what type of risk you're actually fine with. If you don't want to take advantage of this type of volatility, I mean, if you don't feel comfortable doing it, maybe just don't do it. But for those who want to know what to do, or potentially what am I doing myself, here's what I'm planning on doing. The first thing that I'm planning on doing with my portfolio is, first of all, to add more short trades, because obviously as the stock market went down today, almost all of my short trades got closed for a profit, which is good. But the thing is, now I only have a portfolio of long trades, which is not necessarily good because I always like to trade both sides. So that's the first thing. I'm going to add some short trades, but obviously, that's always the hard thing, finding some short trades when the stock market is going down overall. I mean, it's obviously harder because you don't want to sell anything because you think it has already reached the bottom. But overall, I found that adding more short trades at all time and always trying to have like some kind of a delta neutral portfolio is always a better approach rather than just being on one side of the market. I find personally that it's always better to try to be exposed on both sides. That was for the first thing that I'm going to do with my portfolio. The second thing now is that I'm going to look at my trades and my long trades, and I'm going to leave it a bit of time until the end of the week so as to see if the down move is going to continue or not. But I'm going to start rolling my trades to the next expiration at the end of the week or by the end of next week. So I hope this video will have brought you maybe some insights on how I think and what do I do when you have this type of down moves that happens, because it's true that it's not every day that we have, for example, a 2% down move. So it's quite interesting to see what is happening to a portfolio when you're long delta. And obviously, if you're a long delta, you're obviously going to be in a loss. But I wanted to share my thought process because it's obviously during those times that we have like the best opportunities. But of course, on the other hand, and I completely get that, you don't want to catch a falling knife. So it's always a bit tricky. And honestly, there is no right or wrong answer here. If you want to take more, for example, long trades so as to try to catch the bottom, basically, I'd say fair enough. And honestly, trying to sell options when they are at a more expensive price, I don't think you can be wrong here. But I'd say overall, you need to find something that you're comfortable with. If you're not comfortable, for example, trading options when you have a down move like this, I mean, overall, I think you shouldn't. Personally, I came to the conclusion that either way, there is always risk that is involved. And, if you're, for example, long delta, you're going to be hurt during this type of days. And if you're short delta overall, you're going to be right very few times, or at least less times than someone who would be long delta. But, overall, you're going to lose money more often. But when you're right, you're going to be right and make more money than someone who would be long delta. I hope this video was interesting and it brought you some value. If you have any question or any comments, just don't hesitate to comment it below. I'll be happy to answer any question that you might have. Please make good and informed decisions. I'll see you in the next video. And in the meantime, I wish you all the best.